Have you ever wanted to build your own trading bot without writing a single line of code? What if I told you that not only can you create one, but you can build an entire portfolio of automated trading bots completely code-free? In this video, I'm going to show you exactly how to do that. When most people think about automated trading, they imagine a single bot running one strategy, hoping that it performs well. But that's not how real sustainable profitability works. To truly succeed, you need a diversified portfolio of EAs, all running different strategies on different markets with different currency pairs, but all working together to minimize risk and maximize returns. Today, I'm going to walk you through how you can use Portfolio Builder and Set Compare to craft custom EAs that fit your exact trading goals. You'll see firsthand how easy it is to create, optimize, and deploy these bots and build out an entire automated trading portfolio with zero code. So without further ado, let's jump right into the first topic of this video, which is all about diversification. So for that, we're going to jump into the whiteboard here, and we're going to talk about what exactly diversification is and why it's so critical to your automated trading strategy. So on the whiteboard here, okay, when we talk about diversification, there are all kinds of ways that we can diversify, right? We can diversify through currency pairs, right? So that would be like we can trade AUD CAD. We can trade Euro USD, and then we can trade NZ CHF, right? Just off the top of my head, right? Notice that none of these have pairs or currencies rather that overlap with each other. So in fact, if we color code this, you would see, so we have the Australian dollar, and then we have the Euro, then we have New Zealand dollar, we have US dollar. I'm kind of going a little out of order. Sorry, guys. We have the Canadian dollar. Then we have the CHF, right? Let's move, right? Trying to find enough colors for this, right? So this actually makes up, this block here, all makes up the currency pairs that you see above that I just kind of pulled off the top of my head to say, okay, we can diversify. So all we're doing here is by having multiple different pairs that we're trading and all unique currencies of all of those pairs, there's no one news event, or there's no one economical or fiscal or global sentiment event that's going to impact all of these pairs in the same way at the same exact time. So you are now diversifying yourself against all of the unknowns. So when we talk about automated trading, we look at data, we look at analysis, we look at consistency, we look at replication, we look at blueprints that we can follow to make sure that we're always doing the same thing over and over again, and then we can make minor tweaks until we perfect the system that we're building. The things that we can't control, we have to diversify against, right? So we can't control if rates go through the roof in the US because of some decision that was made that's completely out of our control, and the US dollar goes nuts. But what we can control is making sure that in our portfolio of automated trading solutions, we don't have all of our pairs that we're trading in one account dependent on the behavior and the consistency of the US dollar. So in an account where we're running these three pairs that you see on the notebook here, there is only one pair that would be significantly and directly impacted by changes to the US dollar, for example. Okay, so that's one thing. That's currency pairs. Now, the next would be strategies, right? We can diversify strategies. Is the market ranging? Is the market trending? Is the market about to reverse? Right? Is the market tending upward? Are we trending up? In a different color? Or are we trending down? Is the market going down? Right? So we can create biases in our automated strategies by way of backtesting and modifying set files to tailor to markets that are ranging specifically. Separately, we can create separate bots on that same account that are running on that same account, but are specifically optimized to perform when markets are trending. Same for when markets are ranging. We can create we can create bots that go onto the accounts that only look for when markets are moving up and only look for long positions. We can do the opposite and look only for when markets are moving downward and only open short positions. We can combine multiple of these as well too. So I only want to go short on the range because the market has a short bias but is currently ranging, right? So these are the different strategies that we can put into place. Okay, so now we have different pairs and different strategies. Now when you combine these things, it actually gets really interesting, right? And this is the critical part of diversification is that it really compounds itself, is that now you've got 6 different pairs, let's say, and let's say you're running 3 different strategies, right? Well, now you've really got a grand total of 18 different set files that you've created across these 6 different pairs, 6 pairs, 3 strategies. You're going to get 18 different set files that you can run. So when you have 18 different set files, and if we draw a chart like this that shows here's the profit and here's the time, basically, right? You can have your, if this is your range set and this is your trend set and this is your reversal set, you can have your range set going like this, not making a ton of money. Maybe this is 8% in a year, which somebody would say, well, that's crazy, that's less than 1% a month. By the way, we should do a whole other segment on that, because 8% in a year would still outperform a lot of the major indices in the market. But a lot of times in day trading, you're obviously looking to outperform those measures. But okay, so if your trend set does that much, your range set does about 8%, and then you've got a trend set that maybe is doing 6%, and then maybe your reversal set does pretty well, for whatever reason, does 10%. Well, the combination of all 3 of these, we will draw with our yellow line, actually looks like this. And it's doing 24%. So your portfolio has now done 24% on the backs of 3 smaller set files with extremely low risk on an individual basis that do not overlap with each other, because they're 3 completely different strategies. So you did not increase your risk at all in order to take a 10% account, an 8% account, and a 6% account to make 24% on one account. You're able to combine those 3 strategies, those 3 set files, those 3 trading bots into one in order to gain 24% on that account. So then the question, really becomes, how do you, if you're making an automated trading bot, how do you quickly and sustainably create enough different bots? Because if you look, what we're talking about here, that's 3 strategies, that's across one pair. If you really wanted to diversify in the multiple ways that we've just shown, you would diversify 6 pairs on 3 strategies each. That's 18 bots that you would need. Now, if you're having to hard code or build all these bots manually in order to deploy them onto the market and then re-optimize them as markets change, it's not very sustainable. So you need the right tools in place that enable you to very simply and through automation create bots at scale that map to this philosophy, that map to the philosophy of needing different strategies across different pairs. I'm going to show one last way. So we'll get into that in just a second. We'll talk about how we can actually manage this level of bot creation at scale. But I do also want to talk about one last point of diversification, and that's diversification of accounts. Diversification of accounts means you can have prop firm accounts. You can have cent accounts. A cent account, by the way, if you don't know what that is, it's an account that allows you to trade 100,000 cents by putting in a $1,000 deposit, or 200,000 cents by putting in a $2,000 deposit. Now, it's not available in the US currently, but throughout the rest of the world, you can gain access to a cent account. What it allows you to do is gain a significant higher amount of leverage on your deposit, because if you're trading 100,000 cents, essentially it's going to take a single lot or 0.01 lot trade and apply it at a cent value instead of a dollar value, which basically 100x's your leverage on that trade. So you're able to trade small capital, but leverage strategies that are really built for larger capital, which really sort of changes the game. So again, now back to the point here. So you can trade also things like Darwin X, right? Which is really low risk, 0 risk, really. It's a small monthly fee to gain access to a Darwin X account. And if you perform over time, you'll get, third-party investment. Now, these are 3 just quick different types of accounts, and beyond cent account, you can do regular live account, and even beyond this, your prop firm, you can have FTMO, then you can have E8, then you can have Fivers, right? So you have so now you're diversifying further. Cent account, you can have account 1, account 2, account 3, right? So And Darwin X, there's ways to have multiple accounts as well. So aside from just diversifying on the account level, you can then create, multiple under each branch. So ultimately what you're left with is this massive portfolio of different accounts. And then what that allows you to do is, if you go back up to here, is all of these different strategies that you see here, you can further diversify, because you can have low risk, you can have high risk, right? All of these accounts, what it enables you to do is then split them into low risk, you can have medium, and you can have high risk, right? And this could be long-term, for example. These are long-term. I'm getting this prop firm account with the idea of making 1% to 2% a month and holding on to it as long as I can, versus I'm getting this prop firm account, or I'm setting up this cent account to make large profits. And if I lose the account, I'm not going to be upset, because I understand the risk that I took, but the reward is I can push this thing to the limits, right? So this might be more short-term, and this might be more growth mindset, right? Where you're taking calculated risks and pushing the account at times, pulling back at times, right? So again, you've got this massive way to diversify. You diversify against different pairs. You don't want multiple pairs that are conflicting with each other, where the news on one pair is going to impact the other 3 pairs that are on your account. So you're going to diversify at that level. You're going to diversify at the strategy level: range, trend, reversal, long bias, short bias, right? You're going to diversify at the account level: prop firm, cent accounts, investor accounts like Darwin X. And then you're going to diversify at the goal level: short-term goal, mid-term goal, long-term goal. If you do that effectively, you've now got a massive portfolio of different accounts, different levels of mindsets. You're really going to be in a strong place against the market. When the market does things that are unexpected, some of the accounts are going to be fit to manage those in a certain way, while others, like your high-risk accounts, are either going to hit their massive profit, that the reason that you're pushing that account to be high risk, or you're going to potentially lose those accounts, and then you cycle through and you do it again. So you have to have this broad philosophy. There is no one size fits all, and it goes significantly deep. We can go even deeper than this. We can get into double confluence strategies, and we can get into single trade strategies versus sequence trading strategies. I mean, if you're in our community, you see this all the time. This is exactly the chatter that goes on in our community. Endless the number of ways that we can really change the way we think and the way we attack the market. And we can be better than the market by being overly prepared and having all of these different tools at our arsenal, right? So this goes much deeper than even what I'm showing here. The diversification concept is super deep and really spider webs, and it compounds over time. And it's probably the single most critical piece of knowledge and information that you can carry as a trader. Even if you're manually trading, this concept is so critical. But the point of this video is, with automated trading, you can scale your diversification so much broader, because you don't physically have to input these trades. Imagine trying to input trades across 20 to 30, 40 different accounts, all trading different strategies, different pairs, with different goals in mind. You wouldn't be able to do that as a manual trader. That's why automated trading allows for so much broader scale and opportunity, right? Okay, so now let's get into the tools that we use to actually enable this to happen. We talked about the fact that manual trading doesn't allow the scale that automated trading does, meaning you can only diversify to a certain extent as a manual trader, because it's limited by your capacity as a human being to input, enter, and exit trades. But with automation, we have the ability to set up a massive number of bots, deploy them on a massive number of accounts, let them all be diversified, and then just let them run. Now, you can't do that if you're trying to code these bots one by one, or you're trying to grab different EAs from different providers. Now you've got to pay 15 different EA providers for 15 different types of EAs, all of which you have no control over. So you're not even sure that it's being managed the right way. So with that, let's get into Auto Tester here. And we'll talk specifically today about how in Auto Tester, we can set up a test like the one that you see here that is designed to match the philosophy of what I showed earlier in the video about diversifying across different pairs and different strategies. So first of all, what you're looking at here, this is the lineup of different pairs and strategies that we are prepared to test on Auto Tester. Now, we're going to leverage the MT5 backtesting software or capabilities inside of MetaTrader, but we're going to do so with a complementary software called Auto Tester that enables, through complete automation, the backtesting of all of these pairs and different strategies back to back to back without actually having to click anything. I click one button, I click Start, and these are the backtest parameters When it's complete with this back test, it will then move to the next back test and then to the next. And you can see that the trend back tests are using the parameter file set for the trend strategy, whereas the range back tests are set for the parameter file with the range strategy. And now, how do I get the currency pairs here on the left? That's the first question, right? Where does all of this come from? Well, we have this button here that says create non-correlated test list. And if you click it, it says, what are the number of pairs you would like to test? So following the example shown on the whiteboard, let's say I want to do 6 different currency pairs. I would say, okay, let's do 6. How many strategies? Well, let's do 3 strategies: range, trend, and reverse, right? So now it's going to prompt me again. What's the name of the first strategy? It's our range strategy. The second strategy is the trend strategy. And the third strategy is the reverse strategy. And now, do we want to do Forex, Forex and metals, Forex and indices, or Forex, metals, and indices? Obviously, the way to best diversify is to do all of the above, right? So if we do Forex, metals, and indices, which by the way, we didn't even talk about earlier. We talked about diversifying different currency pairs to make sure that you're not overlapping, but then you can further diversify that by adding metals into the mix and indices as well, right? So if we do this, and then you can set in AutoTester, it allows you to set the value between 0 to 100. How correlated or non-correlated do you want to be? Now, the trade-off here is if you try to get too non-correlated, it's going to limit the number of pairs and instruments you can test for. And it's also going to start pulling in some kind of obscure pairs, which might not always be the best to trade, might have low volume, for example. But 60 is a good kind of default value. As soon as I click OK, here is the list that's created for me. It's got all 3 strategies: range, trend, and reverse, evenly distributed across 6 different pairs. So I've now got an entire diversified portfolio ready to test, just like that, right? And you can see CHF, JPY, Euro USD, Pound Yen, NASDAQ, ZUSD, gold, right? None of those are correlated in any significant way. Probably the closest correlation here would be the 3 USD files here, but they are also pushing different currencies in the front of that. So just at a click of a button, we were able to build an entire test list of diversified pairs across diversified strategies. And now we just need to enter the dates that we want to test, and then we click start, and this will run through every single one of these single tests. And then we move on to the next step. Okay, so at the time that the test is complete, you're going to move through, and there's tons of videos in our channel, guys. And those of you in our community, there is deep, intensive, step-by-step training guides on exactly what to do here, and best practices and advanced tactics and techniques. But for the sake of this video, let's assume you followed the steps that I just showed, and you created your non-correlated test, and you ran the test, and now you're looking at set compare. What set compare basically takes the results of those tests and combines them all into a single portfolio. It's something that MetaTrader doesn't do by default. You can see the results of one backtest, but you are not able to take 10 different backtests across 10 different pairs, for example, or 10 different strategies, and then stack them on top of each other to see the maximal drawdown and maximal profitability. You cannot do that in MetaTrader by default. So this tool actually allows us to do just that, and then it presents the data in a way that allows you to see how much profit the entire portfolio is making on a month-over-month basis, and allows you to build a factor of global drawdown value, and then sort the results or filter the results based on that value. So this is a 100K account, and if I am running a prop firm challenge on a 100K account, for example, and my maximal daily drawdown is 5,000, inside of when I do my backtest, I'm going to be much more conservative than that. I'm going to try to build an entire account, diversified portfolios that really never draws down more than 1% in the backtest, because I'm going to assume that the backtest in the live markets is going to exceed the backtest in the drawdown in the live markets is going to exceed the drawdown in the backtest. I'm always going to hope for the best and plan for the worst. That's a critical mindset to have as a trader. So how many times did this portfolio draw down more than 1%? You can filter through and see all of the times that occurred. Now, let me actually back up a bit and show you what's going on here. I'm going to deselect all of these. This window here shows the results from running AutoTester earlier in the video. So this is our different pairs running different strategies. Let's do a very simple example here. Here's Euro USD trend, Euro USD reverse, Euro USD range. This is not diversified on pairs, but it is diversified on strategies. So theoretically, the range set should never be trading at the same time as the reverse set, which should never be trading at the same time as the trend set. And by the way, inside of the EAs that we have at POW, we do have inputs that allow that to never happen, regardless of how the EA may enter trades. If there are those small moments where one bot thinks it's a trend and the other bot thinks it's a range and they both enter a position, there are inputs in our EA that prevent that from happening, that only one bot out of all the ones in the account open the trade to absolutely guarantee diversification, right? So there's little nuances here that you have to look out for, but we've prepared and built for that in mind. Okay, so let's say I've picked these three. Those are the only ones selected. I'm going to refresh this. So what I'm looking for is in this 6-month back test, how many times, if I'm only looking at these three bots, and the three bots again are a bot that specifically only trades in ranging markets and only trades Euro USD, a bot that only trades in reversing markets or looks for reversal points and only trades Euro USD, and then a third bot that only trades with the direction of the EMA, and it uses 3 different EMAs, a short-term, mid-term, and long-term, and the closes of those 1 minute bars have to be above or below all 3 of those EMAs, and then it will open positions. There are other points of entry as well, obviously, but that's the first filter. And again, only Euro USD. So I'm going to refresh this. How many times did this draw down more than just 1% in the last 6 months? It looks like it did it about 10 times. And the peak drawdown was 1.6%. Now, I would look at this from a backtest point of view. And then I would next look at the profit and say, okay, we made 26% in 6 months. And if I look at this on a month-over-month basis, 3%, 3.5%, close to 6%, 3.3%, 5%, could I do with half of those profits and bring my maximal drawdown to just 0.8%? Would I be okay with 1.5% in November, 2% in December, right? And so on. Would I be okay with 13% over a 6-month period? Personally, me, well, let's actually pause there. Let's go back to the diversification concept, right? What is your plan for this particular portfolio that you're building? Is this meant to be a high-risk portfolio that you're going for gold? Or is this a low-risk, long-term sustainable portfolio? Or is it something in the middle? You have to know that ahead of time. And if you do, then this decision-making process becomes very easy. Let's say that I just wanted this to be a set and forget, as much as possible, set and forget, low burn, low stimulating, very, very simple account that wasn't really drawing down very much and that I'd never really had to manage or look at, but it was going to bring me in consistent profits. Well, I might cut the lot size of this in half across this whole portfolio and say, okay, 1.5% to 2% a month is perfect. And the drawdown would never exceed $800 or wouldn't exceed $800 in the last 6 months. Doesn't necessarily mean that's exactly how it's going to play out in the future, but this would be very conservative. On the other hand, we could say, hey, 1.6% is fine. A prop challenge allows me to draw down 5% any given day. Let's double this and let's push it really hard. I wouldn't recommend that, but if your mindset was this is for a high risk portfolio and I'm okay losing it in exchange for potentially making massive gains, you might go that path. But the point is you have this visibility, right? And what's even better is if I hit the show graph button, you get this level of visibility, sort of like what I drew on the whiteboard earlier. The colored lines on the bottom are showing every individual strategy, right? The blue one is our trend. The orange one is reverse. The green one is range. The dark blue one is the total of the entire account. Now I can push this even further. That's just Euro USD. Let's say I also want to add NZ USD, range, reverse, and trend. I've now got 6 different bots on this one account. And if I refresh, let's push this a little farther. Let's see how many times did it draw down 2%, if at all. Okay, one time. This is 6 different this is 6 different trading bots on one account, trading 3 different strategies each. So each pair, three different strategies per pair. So 2 pairs, 3 strategies, a total of 6 bots. And in the last 6 months, it only drew down 2% a single time, and it drew down 2.1%. And you can see that the NZUSD range bot was drawn down about 0.5%. The NZUSD reverse bot was drawn down about 1.5%. So there was some overlap that happened where the market was ranging, and then all of a sudden it pushed down the opposite direction of the current trend, and those two were opened at the same time. This could actually even be prevented from what I said earlier, which is where our bot wouldn't allow, our EAs have an input that won't allow 2 pairs to be open at the same time. So this actually may have never even happened in the last 6 months. But let's say it did, on a 2% basis in a 6-month period, you've now created this diversified portfolio that only, that with very minimal risk relative to the profits that it's able to make as a holistic portfolio. So you get this chart view, all 6 of those are clustered together. And you can see month over month what the potential is for this set file to make. So this is 47% in a 6-month period, which is an absolutely outrageous amount for this to have made, right? So, and you can go further. You can add even more than that. You can diversify. So like this, for example, maybe because these are both dependent on USD, maybe you want to do GP, pound yen here. Let me just get rid of this. So if we're looking now, we've got 5 set files. We've got range, reverse, and trend Euro USD, range, reverse, pound yen. The back test for pound yen trend, I guess, didn't return any decent results, so we just omitted them, which is fine. And this is even further diversified, as you can see. Never drew down more than 2%. What about 1.5%? Yeah, so it looks like the maximal drawdown was about 1.9% actually. 1.5% happened about 4 times, it looks like. And if we go to the graph, once again, you can see here's the holistic portfolio return, and here are each individual set files returns combined. So this is the power of these tools, this quick analysis. Within seconds, I can pull together different bots, different strategies. First of all, within a matter of hours, but without me having to do anything, I can build enough bots to then pool in and take only the best results, only the best possible bots that I even want to analyze. And then at a glance, I can analyze them very quickly and then start to make decisions about what I'm going to put actually into my live portfolios. So that's how we create bots at scale. And not only how we create bots, but how we create diversified bots and how we combine them together and how we analyze the potential of those bots combined together to really create diversified portfolios that we're then going to put into the market. And we're able to retest these things on an ongoing basis to ensure that they are in line with market conditions. So when you compare that to a manual trading strategy, there's no way you can outperform this from an analysis standpoint, because you just simply don't have the capabilities as a human being to input trades into 6, 12, different accounts, all running 6 to 12 different strategies across multiple pairs. It's just not humanly possible. So this process, this blueprint, this tool allows us to do everything that's needed to really build a scalable portfolio through pure automation. Okay, so now that you've seen this, let's actually jump through some successful examples of this. Let's see what this looks like in the real world. Okay, so now that you've seen sort of how everything gets set up, I want to show you some examples in the real world of this working. So as an example, in our MyFX book account, this is gold 3 strategies. So exactly what we're talking about, range, reversal, trend. This has been running since March of 2024. So over a year of data here, 200% gain. This continues to be re-optimized and to stay in line with market conditions and continues to grow. And this is running just gold. So it's not diversified on the pair level, but it is diversified on the strategy level. Now you might combine this with other master accounts so that you can also bring in different pairs, which is another tactic to use, to have multiple master accounts running multiple things so that you can pull different master accounts, copy them all into a single slave account, and now that's diversified as well. And then separately, this is a different account that's more short-term. I'm showing this because this is an account that all the set files are actually available in the member community for our members to grab, especially if you're new and you're just starting. So you don't have, while you're learning the backtesting process, like what I just showed, you do have accounts like this that you can just throw on to your own accounts so you can get used to the bot trading. And this is up 32%. This is actually it inside of Social Trader Tools, because I think the views sometimes are a bit better. $30,000 profit, a gap up here. But outside of that gap, very steady growth and very consistent growth over time. And you can see the multiple different pairs that this strategy is trading. So it's multiple strategies across multiple pairs, all contributing in different amounts in order to globally get this amount of return. Separately, this is an account that's short-term as well. That was a specific account that's only trading ranges, but it's a single trade strategy. So again, different type of strategy on a different account, specifically looking for ranges. And you might copy this account plus this gold account all into one slave account and significantly reduce the lot size to create, again, more diversification. But just showing here, different methods, different modes of trading, and different ways to put the tools and tactics that I just showed you in this video to work. And you see the results here on just a handful of accounts that we have live in the markets today following this exact blueprint. And that's how you can build your own fully diversified portfolio of trading bots with absolutely no coding required. If you want to take your trading to the next level and automate your strategies with ease, click the link in the description and check out Portfolio Builder for yourself. Make sure you subscribe to the channel and turn the alerts on because we have all kinds of content like this coming into the channel on a regular basis, showing all kinds of different ways to automatically trade in the markets for sustainability and long-term growth. So thanks for watching, and we'll see you on the next video.